Today, we are going to cover the big shakeup that we're going to see in the condo market in Oahu, quite frankly, across the entire nation. Why starting August 3rd, the rules are going to change, and this impacts many of my clients, veterans, first responders, first-time home buyers, anybody who owns a condo, is on a board for a condo, is looking to sell a condo, looking to buy a condo. This is something that you need to pay attention to, and it's gonna impact you. And let me tell you, it's not gonna impact you in a positive way. The GSEs, Fannie Mae and Freddie Mac, a GSE is government service entity, they are tightening the condo rules, and there's a couple of reasons why. First, the Champlain Tower South collapse that happened in 2021 really caused Fannie Mae and Freddie Mac to more closely scrutinize building safety and HOA financial health. And then on March 18th, 2026, Fannie Mae's lender letter and Freddie Mac's bulletin were issued jointly and coordinated with the FHFA, the Federal Housing Finance Agency. And why is that important? Because nearly 70% of the mortgage market, residential mortgages, follow Fannie Mae and Freddie Mac guidelines. So these changes are going to ripple through the entire market when it comes to condos. Now, some of you might be saying, well, does this impact me? I'm a veteran. I don't even have a VA loan. Well, it does, and we'll get into that here in a few minutes. So here are 4 key dates that you need to think about when it comes to these new rules for condos. The first 2 have already passed. One, the rules were announced in March. July 1st, deductible cap begins. Basically, $50,000 is a max per unit deductible on master insurance policies. The big thing there is any shortfall has to be covered by the owner of that unit, which is going to increase their homeowner's insurance. And then August 3rd ends the limited review program. With condos, with condo purchases up to this point, if you're putting a down payment larger than 15%, larger than 20% or larger, you could get away with doing a limited review. And basically on Monday, the limited review ends. Before, if you had a down payment that was more than 10%, you could get typically more than 20%, you could get a streamlined or limited condo review. Well, starting August 3rd, every condo is gonna get a full review. We'll get into that, but what does that mean? Well, we'll get into that here. January 4th, though, is another big one. That's when reserve rules tighten. The minimum reserve funding right now is at 10%. Starting January 4th, 2027, that goes from 10% to 15% of the association's budget, all right, has to do with the minimum reserve funding. So guess what that means? Many HOAs, especially if they haven't been managed right, you're gonna see increases in those HOA dues starting 2027. So what is a full review? Well, a full review, man, it is, as a lender, it is painful. It is especially painful if your HOA and your property management company don't have their papers in order, all right? A full review digs into annual operating budget, all right? It confirms the fiscal health of the association, of the building, reserve studies and findings, all right? They must be current and they must follow the recommended funding level. You also have to have the master insurance policy, property, flood, hurricane, all right? All of those must meet GSE requirements. They also look at the number of owners that have HOA delinquencies. With all of the HOA increases, especially on island, and I talked about that last week where my average HOA payment that I put on any pre-approval is $1,000 now. When I started 10 years ago, it was $500. All right, so as HOA dues go up, you can expect, especially with many owners who are not present, they are not paying their HOA dues on time. You got pending litigation, all right? Any lawsuits involving the association could put a kibosh on your deal altogether. I think you gotta look at what we're seeing a lot, special assessments, all right? What's the history of special assessments? What are the planned assessments moving forward? All right, this full review isn't new. If you're buying a home and you're putting less than 10% down, you are getting a full review. Well, now everybody gets a full review. The only way you won't get a full review is if you're buying all cash. So, what does this mean? Well, if you're a homeowner and you're trying to sell your home, don't expect a 30-day close. If your HOA association documents, if any of these things that we just talked about, any of these 6 items are not right and tight, you can expect a slower process and possibly disappointment at the end of the entire transaction when the bank says, you know what, we got no loan here. This home is too risky. And then it will go from a warrantable condo down to a non-warrantable condo. And what that means for the buyer is higher rates in most cases if they can get a lender that will lend on a non-warrantable condo at all. One of the good things though, there is a break for smaller buildings, and you can get a waiver of a project review if you are a boutique, small 5 to 10 units, and you're not part of a larger master association. These full reviews will not be required, but the building must meet standard property and flood insurance requirements, so you still have to have the insurance. You can't have any critical repairs or evacuation orders in place. And again, the big thing here is small associations can skip it altogether. But you know what? Most condos are more than 10 units. So really doesn't impact many, but there are some CPRs on island that are, 5 to 10, not even 10, 3 to 5 units. So they should be okay. But it's those larger condo associations that you're going to see this problem. So let's talk about insurance. There's some good and there's some bad with the changes to insurance. The first one actually went into effect on July 1st. And that, again, I mentioned it briefly, it put a 50% deductible cap on master policies. They can't carry any more. So if the association's deductible sits at that level, each owner needs a personal homeowner insurance policy that covers the gap, including their share of that deductible. So really these two changes are pulling in opposite directions. This first one is a tightening. All right. Again, your insurance price could go up. The good thing though, and I've had this problem happen in the past, is roof coverage relief. The old rule required 100% full replacement cost value. Well, that is no longer in place. The roofs may now be covered by an actual cash value basis without triggering automatic financing rejection. So that really does ease some pressure on older buildings, aging buildings. So that's a little bit of relief from Fannie Mae, but still, your insurance dues could be going up in some condo units. What are you thinking as I talk about this? If you own a condo, who's on your board? What are they doing to ensure that they are ready? Because the association wants to protect the value of the properties. They obviously want to protect the safety, but they want to protect the value of their properties. Is your reserves updated? Have you had an audit on your budget? Have you had an audit on your reserves? These are so important. And if your HOA is not responsive, you could find yourself in some serious trouble. So super important. Anybody who owns a condo needs to be watching this right now. You need to share this. If you haven't shared it yet, you need to share it. And if nothing else, you need to start asking questions of your association and your property managers. All right. Here's where we're going to see some big changes, and we could see further increases in HOA dues. All right. Reserve funding gets stricter. Today, you need to have 10% of your budget is allocated for reserves. Starting January, that's 15%. Have you done your budget for 2027 yet? Has your association started working on its budget for 2027? All right, it's going to change. It has to be 15%. How are they going to pay for it? All right, I know some associations have already raised their HOA dues because they had shortfalls in their HOA, in the amount of money in their HOA reserve accounts. Well, they're going to have to ensure that they have at least 15% of the budget going towards those reserve requirements. And if they're not, well, what are they going to cut? Chances are they're not going to cut much. I mean, I don't think they will. Possibly they will. Hopefully they do. But otherwise, you're going to have to raise. You can expect at least a 5% raise in your HOA dues coming up in January of 2027. Here's the other sticking points. Again, this is why it's so important that you go to your board meetings, that you are involved in your board, because you must have a reserve study, and it must recommend, and the HOA must follow the highest funding option, not the baseline. Again, why is this happening? Is it happening because Fannie Mae and Freddie Mac just want to be dicks to associations? No, they don't want to see what they are seeing now is lapses in judgment in associations and condo complexes that deal with safety, and they deal with the financing of those properties, and they want to make sure that you are protected. Unfortunately, you being protected means higher prices overall. Studies older than 3 years or built on baseline funding will knock a project back to default 10% funding or full ineligibility. Very important. All right, when was the last time your reserve study was done? If it was more than 3 years ago, your association, your complex may no longer be eligible for conventional financing. All right, that's a big one. If you sit on an HOA board or you manage one, the message here is simple. Get a current reserve study done on the recommended funding level well before January. Don't bury your head in the sand and then get slapped in the face by higher rates in January. Start prepping now and see how you can mitigate that risk for your association, certainly mitigate the cost. Let's talk about one more change that's worth noting. The investor concentration cap has been eliminated. That actually was eliminated in March. The old rule rejected investor loans once more than 50% of the established project units were non-owner occupied. That cap is gone, folks, which opens financing in communities with more rentals. Now, you might say, well, we don't want more investors. You know what? Investors may be the only people buying your properties if association dues go so high. So really, this actually is going to help alleviate some of the pain that condo owners may feel when normal conventional financing kind of begins to dry up. So, the other big question is, and I've had realtors ask me, how does this impact VA buyers? Well, it does not directly, because the VA doesn't use Fannie Mae or Freddie Mac. The VA uses Ginnie Mae as their government service entity. And the VA guarantees the loans separately, and it runs its own VA condo approval process under the VA Lender's Handbook. Now, I will tell you this, the review for the condos is done once, and unless there are issues that pop up, I know some condos have gone from approved to not approved or approved with conditions over the course of time due to litigation. A lot of times it's really due to litigation. But a full review isn't required. A 15% reserve rule isn't required. And the $50,000 deductible cap, that's not in the VA Lender's Handbook. So directly, no impact. But indirectly, man, it absolutely does. All right, your building health signals overlap. All right, if you buy a home and you buy into a condo that has weak reserves or high delinquency, those are not only are those red flags to sell your condo, but they could be future red flags to the VA, which could cause that condo to become ineligible for VA funding. So overall, the VA is more lenient, and a building that just lost conventional warrantability will most likely stay approved by the VA, because quite frankly, the VA doesn't have time to deal with all the other stuff the VA is doing. All right, they're not going to dig deep unless something causes them to dig deep. But again, this is also not automatic. You must always check the VA condo approval list. And quite frankly, that list it's crazy. I mean, sometimes it's not as transparent as it should be. Actually, oftentimes it's not as transparent as it should be. Then it may not be in the VA lender handbook or the VA condo approval list. Your condo may not be there by the name of the condo. It may be by the street name. It may be by the street number. It's kind of wacky how it is. So when in doubt, ask your lender. We'll find out whether your condo unit is VA approved or not. But this is so important for VA owners, because if 70% of all residential home loans are conventional and you lose Fannie Mae and Freddie Mac eligibility for your condo, well, you've just cut out 70% of the potential buyers of condos into your unit. So it is a huge direct or indirect impact, though not direct right away. And then let's look at the impact overall for sellers. All right, you're gonna have a smaller buyer pool, and you're gonna have slower closings. All right, the hardest loans to close for me are condos, especially conventional. VA is not hard at all, but the slowest are typically conventional condo purchases, and many of them actually flip over to non-warrantable. And then for buyers left with non-QM, which is just a different type of mortgage, but or a portfolio loan, they typically need 20 to 25% down, and those rates are going to be higher, which again shrinks the pool of qualified buyers to buy your property or your condo unit at all. And the value risk is building wide. It's not just you, it's everybody in your building that's going to face the same issues when they go to sell their property, when they sell the condo. And again, for the sellers, this reserve catch-up is going to hit your wallet if you cannot sell your home, and it could hurt the timing of your sale, because people are not going to want to buy a home that they know is going to have a $10,000 assessment to catch up on the reserve. So really, it's going to take associations. They got to get together now. They got to figure out how they can adjust to these changes that are occurring. This is a big deal, folks. This is a really big deal. So what to do now between now and August 3rd? Well, it's really, I won't say it's too late, but what to do now? All right, one, check your closing date. If you're a conventional buyer, check your closing date. You're buying a condo. If you weren't doing a full review, you were doing 20% down, you weren't doing a full review. If you don't close by August 3rd, you're going to require a full review. And I would ask my lender what review applies. Well, because nobody ever asks that question, really. The realtors sometimes do, but most of the time they do not. Agents to sellers, man, up front, request the HOA questionnaire and the financials the day a contract is signed. As soon as you go on a contract, man, get that information. Seller's agent, do yourself a favor. Get that information, provide it. All right, go through it with your seller so that you understand any complications you're gonna find or that your buyers are gonna find once you go into contract. Take a look. All right, what is the reserve study age? Is it greater than 36 months? All right, that will make or break a deal. And then HOA boards, get hot. All right, order a current reserve study on the full funding requirements now, and review the master policy deduction against a $50,000 cap. Man, I've been on an HOA board. My wife is on an HOA board now. It is a thankless job. You don't get paid, but you know what? If you do it right, you get paid when you sell your home. You get paid when the value of the properties in your neighborhood, in your condo unit, continue to go up. And while we buy a home for a roof over our head, ultimately, we're probably gonna move. We're all gonna move at some point. We wanna make sure that investment provides us with enough money to maybe make that next investment. So anyway, HOA board, super important. That is what this is what you need to do between now, quite frankly, and the end of the year. I know I spent a lot of time on this. This is probably a long form video, but whether you're a veteran using your VA benefit, you're a first time home buyer, you're on an HOA board trying to figure out the way ahead. Hey, these rules, they're not the end of the world, but the sooner you act, all right, the sooner you take action, the better off you'll be. Reach out early, get those reserve studies done early. And if you're looking to buy, man, just hit me up. Let's go through this together. Let's make sure that you're making the right decision I do believe in the power of home ownership, but I don't believe in the power of risky, unnecessary risks in home ownership. Do your homework ahead of time to make sure that you're making the right decision for you and your family.